I thought I'd take the time to put together a small video to help walk you through cash flow modeling. This should serve as a review for you more than anything else. In this video, we're going to look at how cash flow is calculated. We'll look at the various inputs to cash flow, starting with cash flow from operations, which begins with a cash flow stack. So we'll look at forecasting the cash flow stack. We'll look at cash flow from investing and cash flow from financing. You may recall that cash flow is the result of inputs from the income statement and the balance sheet. These inputs include aggregating into cash flow from operations, cash flow from investing, and cash flow from financing. And if you sum these up together, they become cash flow for any period of time. We'll go through each of these categories and look at the inputs necessary to calculate them. First, let's look at the cash flow from operations, and we'll end up looking at the cash flow stack that results in this in a few moments. The cash flow from operations is part of the income statement and part of the balance sheet. So for the income statement here, we're looking at net income, and then we're looking at depreciation and amortization. We then will look at items from the balance sheet. We'll look at decreases or possibly increases in inventory and how those affect cash flow, decreases and increases in accounts receivable, increases and decreases in credit card balances, and increases and decreases in accounts payable. So consider what is really being said here. We're adding to cash flow, or we're creating cash flow from net income. And since depreciation and amortization were already deductions from net income, we're now adding them back. We're adding to that cash flow from operations, and net income is part of our operation, of course. We're adding to that any changes in inventory, accounts receivable, credit card balances, and accounts payable. If it's an increase in inventory or an increase in accounts receivable, that's a reduction in cash flow. Think of it this way. If you buy inventory and pay for it, that reduces your amount of cash. That's a negative cash flow. That's a reduction to cash flow. If you take on debt through credit card and buy something on credit cards, well, that's money you didn't have to spend in cash because you actually took on the debt instead. That's an increase to cash flow. So together, these create cash flow from operations. The cash flow stack for forecasting net income starts at revenue. We subtract out any cost of goods sold. That results in gross profit, of course. We subtract out any operating expenses, resulting in operating income or EBIT. Now, remember that one of the operating expenses that we subtracted out of gross profit was depreciation or possibly amortization. And because these are operating expenses that we have subtracted out, and because they're non-cash expenses, we're ultimately going to have to put those back. But in this case, let's just think through the rest of the stack. So from operating income, which I said is also called EBIT, we will subtract out any non-operating expenses. That takes us to taxable income. Subtracting out income taxes paid takes us to net income. So let's think about how we forecast revenue. So the questions you would want to ask yourself is, where's revenue coming from? So what's the expected growth in revenue over the next several years? Is this a function of management plans, or is it market trends, or is it just general economic conditions? So these questions that I posted here for you are the questions that you really need to ask when you're thinking about where is revenue coming from. how are we forecasting revenue? And we're thinking about our plans, we're thinking about trends, we're thinking about new products that we might be introducing, we're thinking about what our customer growth looks like. Are we adding new sales staff? Are we adding new production lines? Are we expanding to another part of the country? Will we have price increases? Will inflation be part of the mix that we need to consider? Are there new markets that we're penetrating? All of these, and probably many more, are the questions that you would need to consider when thinking about forecasting revenue. This is just a good basket of questions for you to think about to begin with. And you would want to try to answer these questions for each and every year in which you're creating a revenue forecast. We then need to think about forecasting cost of goods sold. It's reasonable to expect that cost of goods sold for any one period divided by the revenue for that period will give us a forecast ratio for cost of goods sold, or some percentage of our revenue that we can think of as cost of goods sold. And if you know this number for a given period, and if that period is representative, or you know this number as an average for several periods. Say we took the average of the cost of goods sold for the last 5 years and divided it by the average revenue for the last 5 years. That's going to give us the average forecast ratio for cost of goods sold for the last 5 years. If we think that a 5-year average is representative, then we're going to use that ratio. If we think that 1 year is a representative year and that it's accurate as a representative year, then we can simply use that ratio. Regardless, we're going to think of cost of goods sold as some percentage of revenue each year. If we know what the revenue should look like for each year, because we forecast that year's revenue and multiply it by the cost of goods sold forecast ratio, we can then forecast the cost of goods sold for that year. Well, we can look at operating expenses sometimes in much the same way. Some operating expenses, such as general and administrative expenses, sales and rent, and some other incidental operating expenses, may well be percentages of revenue. And just like cost of goods sold, we'll start by looking at those expenses for any given year and dividing them by revenue for that year. And that would give us then a forecast ratio for that expense. Or if we think that any given year is not representative of the future, maybe we'll take an average of the various expenses for a given period of years, maybe 3, 4, or 5 years. We'll take an average, let's say, of sales and marketing for 5 years, divide that by the average revenue for 5 years. That would give us then the average forecast ratio for revenue for that same 5-year period. And we can apply that against our revenue, that percentage ratio against our revenue, and that would give us an estimation of what sales and marketing expense would be for any given year. Some expenses, perhaps like employee expenses and like rent, may not be a percentage of revenue, though. Employee expense probably grows as we add new employees or grows at some rate of inflation as wages rise. Rent expense is most likely the result of having some lease contract that says that we have to increase our rent payment or our lease payment by X% each year. Maybe it's 5%, maybe it's 3%, and maybe it's even 0, but it's spelled out in our lease contract. Depreciation and amortization expense for any given year is going to be a function of our gross fixed assets and divided by whatever their useful life is. So we may look at some of our operating expenses as being a result of revenue, or we may look at some of our operating expenses as having some dynamic of change, some percent change from 1 year to the next, or we may think of our operating expenses as being nominal dollar values. Regardless, we need to give some forecast to them using one of these 3 methods for each year. We also need to think about forecasting our non-operating expenses, the most common of which is interest expense. And interest expense is going to be the result of having long-term debt and possibly credit card balances. So we can identify, say, the long-term debt balance for any given year based upon whether we've taken on new debt from the prior year, or we've paid off some debt from the prior year. And then we can multiply that by the interest expense we're paying on our long-term debt. We can do the exact same thing with credit cards. We then have to think about the non-operating expense, which we call state or federal income tax. And unless you have better information, you're always going to forecast this at 26%. And so we would take whatever our taxable income and multiply it by 26%, which breaks down to 21% federal and 5% state on average. These allow us to forecast out the rest of the income statement, such that we have forecast our revenue, our cost of goods sold, that leads us to gross profit. We then forecast our operating expenses, which leads us to operating income or EBIT. We then forecast our non-operating expenses, which leads us to taxable income. And we then forecast our income taxes to be paid, which leads us to net income. So we're going to try to keep some of the rest of the cash flow from operations relatively simple. We're going to suppose that accounts receivable, inventory, credit cards, and accounts payable are all changing at the same rate as sales are changing. We're also going to remember that as inventory and accounts receivable increase, that's a negative to cash flow because it consumes cash. As credit card balances and accounts payable increase, that's an increase to cash, so it's going to be positive cash flow. So we've looked at cash flow from operations briefly, and we'll look at this in some spreadsheets in a few minutes. And now let's look at cash flow from investing, and then we'll move on to cash flow from financing. Well, what do businesses invest in? They invest in things that will help them either create revenue or reduce expenses. Unless it's an investment business, like a wealth management firm or an investment advisory firm or an investment bank, businesses don't invest in stocks, bonds, and mutual funds. They invest in fixed operating assets, various types of property, plant, and equipment. And when they invest in those, they then expend cash to acquire them. Now, sometimes after having invested in them, they may sell them off. So selling them off creates cash flow. Investing in new assets consumes cash flow, and the sum of those two would be the cash flow from investing. We think about investing in much the same way as we think about revenue. Businesses need operating assets in order to create revenue. If you have a printing company, and if you don't own a printing press, if you're not expanding your stock of printing equipment, then you probably are having a difficult time expanding the amount of printing work that you're doing for customers or supporting new customers. So we always are looking at what additional assets are needed to be able to grow, what older assets might we be selling off, and do we need to replace any of our technology or our equipment just to keep it current and keep ourselves competitive? Together, these result in positive and negative cash flow from investing activities. So now let's think a little bit about cash flow from financing. Financing includes equity, debt, either acquiring investors that bring on new equity for us with paid-in capital, or by borrowing money from banks or through the markets, or by paying off debt, buying out investors by buying back equity, or by paying dividends and distributions. So let's think about each one of these for a minute. So if our company borrows money from a bank, then that's a positive cash to the company, so that increases cash flow. If we pay off an existing loan, all or in part, that's a negative to cash flow. If we receive capital from equity investors, we call that paid-in capital, that's a positive to cash flow. But if we buy out existing investors, either because we've chosen to reduce the number of existing investors or because we are offering a stock dividend of some kind through a buyback, then that's a negative to cash flow. Or if we're paying dividends or distributions to equity stakeholders, those are negative to cash flow. Sometimes we've gone out and borrowed money in order to pay for those investments that we've made. So in this case, if we buy an investment, let's say we buy a new truck for $100,000, that's going to be a $100,000 negative to cash flow from investments. But if we then borrowed the money to buy that truck, maybe we borrowed 80,000 of it, that 80,000 would be a positive to cash flow from financing. So remember to consider these kinds of issues when you're dealing with cash flow from financing. Well, forecasting cash flow is looking at the future cash flow from operations for a given year and the future cash flow from investing for a given year, the future cash flow from financing for a given year, resulting in the cash flow for that given year. Remember that if we're looking at how the cash flow affects the cash balance in our cash accounts, let's say our checking account, then we have to realize that the cash balance at the end of one period, which by the way is the same thing as a cash balance at the beginning of the next period, but the cash balance at the end of one period plus the cash flow from that period becomes the cash balance at the end of that period. So let me say that a little bit differently. Let's assume that for 2024, we had $1 million in our checking accounts. That was our ending balance for 2024. That would be synonymous with our beginning balance of $1 million for the beginning of 2025. If we then had $500,000 in cash flow for 2025, the resulting ending balance for 2025 would be the $1 million beginning balance plus the $500,000 cash flow, resulting in a $1.5 million ending balance or cash balance at the end of 2025. So what I'd like to do now is move to a sample cash flow projection utilizing a relatively simple income statement and balance sheet construct for BBSJH LLC. So this is an enterprise solutions consultancy formed by graduates of Westminster's Bill and Vive Gore School of Business. The company was put together in 2018. It had modest growth through 2024. Like many companies, it struggled during the COVID-led pandemic, but it recovered nicely afterwards. So let's look at each of these elements of cash flow, and let's look at some of the assumptions that we might have to make in order to project for our future. So first, we're looking at the historical values. So we see here what the revenues, cost of goods sold, gross profit, various operating expenses, including depreciation separated out, operating income, non-operating expenses, taxable income, and then net income are for each of the years 2020, 2021, 22, 23, and 24. Now we know that these net incomes were the foundation for those years' cash flow. We will utilize these net incomes and the revenues, expenses, etc., from which they result as the foundation to forecast net income for future years, which will help us then forecast cash flow for those same future years.